Well, there's still one more trading day until you can break open the bubbly, but investors around the world are already celebrating as 2013 comes to an end. Global stock markets are up about 10% this year. The Morgan Stanley All-Country Equity Index is at its highest level since the financial crisis began back in 2007. When you break down the numbers, though, the statistics are amazing. Japan was the best performing stock market, up a stunning 57%. That's the strongest increase since 1972. And stocks here in the U.S. performed remarkably well as well. The Dow is on track to post a gain of 25%, and the S&P did even better, up almost 30%. As for today, the blue chip average hit another record and closed at a new milestone, 16,504. The Dow rose only 25 points. Still, it was enough to post its 51st record for the year. The Nasdaq lost 2, and the S&P was down a fraction. In the bond market, the yield on the 10-year note touched 3.3%, but slid back to close at 2.98%. David Kelly is predicting another strong year for U.S. stocks, but says the best opportunities will be in Europe. He's chief global strategist at J.P. Morgan Funds. Hi, David. Nice to have you with us.
Glad to be here.
So, David, tell us why Europe. You know, we still see headlines regularly coming out of Europe that make investors kind of concerned. Why do you think that this is where you can have your best opportunities?
Well, of course, that's the case. But if you look historically, the best time to invest is usually when everybody's really worried. And people still are worried about Europe. They've got an unemployment rate in the Eurozone of over 12%. But the reason I see some opportunity in Europe is we are seeing some improvement. They're gradually beginning to pull out of this long series of recessions that they've had. And if they could just get back to normal, even if it took a number of years, I mean, normal for Europe would be about a 7% unemployment rate, maybe a 6% unemployment rate, pretty much the same as here. But we're quite close to that. They're not. So over a number of years, if they can get back to that, if they can get back to full employment, it means a lot of economic growth, it means a lot of earnings growth, and I think it means a lot of stock market appreciation. So there's just a lot of room for them to improve.
And we're also hearing from a lot of strategists that the emerging markets are also making a comeback. They had a really lousy 2013. What do you think?
Well, there are a lot of minefields. I think as an investor, as a long-term investor, you've got to have emerging markets in your portfolio. I think you need a source of growth for the long run, and emerging markets will give that to you. But I do think it's an area where you need to have professional management. There are still a lot of issues. I think there are issues with some areas of commodity markets. And there's a whole issue with, China is slowing down. Can China manage its pace of slowdown? Because if it slows down too much, that affects commodity exporters like Brazil, like other Latin American emerging markets. So there are plenty of issues. But in the long run, they've got growth in their population. They've got growth in the labor force. We don't have that in the developed world. And also emerging markets have had a pretty rough time the last 2 or 3 years. They are relatively cheap compared to compared to developed markets right now.
As you know, American investors, especially individual investors, always feel comfortable investing right here in their own backyard. Tell us how U.S. stocks are going to do this year, and should investors, what kind of balance should they have between U.S. stocks and stocks around the world?
Well, of course, I'm not going to give you a straight answer to how they're going to do this year, because, and I'll tell you why. If you look back over the last 3 years, 2 years ago, the stock market gave you 0%. Last year, it gave you 16%. This year, it's going to give you about 30% in the United States. Now, in each case, we had an upward trend, but year to year, it's very hard to pick. But I'd say over the next 5 years, you could expect to make 5 to 7% per year in U.S. stocks. So I think that's pretty good. But still, I think there's better opportunity around the world. And particularly because over half the stock market opportunity in the world is actually outside the United States. The U.S. accounts for about 48% of world stock market capitalization. There's more opportunity overseas. And I think this is a time when the market's gone up this much, people need to sort of look around and think more broadly about where there might be opportunities for the next 5 years.
All right. We got to sit down and do the math and figure that all out. Thank you so much, David, for coming on the program.
Anytime.